Lesson number 1, Part 2 of 2, Credit Basics. Personal Credit Basics. Lesson number 1, Part 2 of 2. Welcome back to the channel. Let's continue lesson number 1. So, what are credit scores and how are credit scores calculated? I personally think credit scores are just adult GPAs. Seriously though, your score is your financial reputation, and banks, lenders, employers, insurance, companies, and others take your reputation seriously. There are many different types of credit scores. There are literally thousands of companies that sell their own white-labeled credit reports, and most use their own scoring models that were made up by them. So, the score you get from one place to the next will typically be very different. Regardless, the scores are intended to help you gauge how good or bad your credit is. But more importantly, it's to help the banks, lenders, and other companies make complex, high-volume lending decisions about you. Let's discuss how scores are calculated. So, the biggest chunk of your credit score is primarily payment history. This is approximately 35% of your total score. When you're late or you miss payments, it obviously impacts your payment history and lowers your credit score. In general, risk scoring systems look for negative events, like charge-offs, collections, late payments, repossessions, foreclosures, settlements, bankruptcies, liens, and judgments. Within this category, credit scores consider the severity of the negative item, the age of the items, and the prevalence of negative items. Newer is worse than older, more severe is worse than less severe, and many are worse than few. Basically, not paying on time can devastate your credit scores. Also, debt is a huge factor and accounts for roughly 30% of your score. Scoring models consider the amount and type of debt carried as reflected on your credit reports. There are 3 types of debt considered. 1. Revolving. 2. Installment, and 3. Open debt. Let's talk about each type of debt because it really does matter. 1. Revolving debt. This is usually a credit card, retail card, merchandise, or gas card. Basically, if you use it, then pay it, then you can use it again. It's considered revolving. The most important measurement from this category is called revolving utilization, which is the relationship between the consumer's aggregate credit card balances and available credit card limits, also called open to buy. This is expressed as a percentage and is calculated by dividing the aggregate credit card balances by the aggregate credit limits and multiplying the result by 100. Thus, yield the utilization percentage. The higher that percentage, the lower your score will be. This is why closing credit cards is generally not a good idea for someone trying to prove their credit scores. Closing a credit card account will reduce your total available credit limits and likely increase the utilization percentage unless the card holder reduces their balances at the same pace. Next, installment debt. This is a debt where there's a fixed payment for a fixed period of time. An automobile loan is a great example, as you're generally making the same payment for either 36, 48, or 60 months or longer. While the installment debt is considered in credit scores, it's not nearly as important as revolving debt and holds far less weight. Installment debt is generally secured by an asset like a car, a home, or a boat. Consumers will typically make a far greater effort on secured accounts to make sure that their payments are on time, so their asset isn't repossessed by the lender for non-payment. Next, open debt. This is the least common type of debt, but I would like to go over it anyway. This is a type of debt that must be paid in full each and every month. A good example is a credit card that you're required to pay in full every month. The American Express Platinum, Gold, and Green cards are common examples. Your credit history, also known as time on file or credit file age, accounts for roughly 15% of your score. The reason why it impacts 15% of your score is because lenders know that the older your credit is, the more stable it is. This age is determined in 2 ways. 1, the age of your credit file, and the average age of the accounts on your credit file. The age on your credit file is determined by the oldest accounts, date opened, which sets the age of the credit file. Secondly, the average age is set by averaging the age of every account on your credit report, whether open or closed. Another significant factor of how your credit scores is calculated is account diversity, which is also known as types of credit used. This is approximately 10% contribution to your credit score. Your credit score will benefit by having a diverse set of accounts on your credit file. Having experience across multiple account types like installment, revolving, auto, mortgage, credit cards, etc. is generally a good thing for your scores because you're proving the ability to manage different types of accounts. Next, and one of the smallest parts of your credit report, is the search for new credit, also known as credit inquiries. Each time your credit is pulled by anyone except you, for permissible purpose, in search of credit, it has an impact on your credit worthiness and your scores. A soft inquiry is when you pull your own credit and it does not impact your score. However, when someone else pulls your credit, it's considered a hard inquiry, and it's visible to lenders and credit scoring models. Keeping inquiries to a minimum on your credit report can help your credit rating. A lender may perceive many inquiries over a short period of time on your credit report as a signal that you're having financial difficulty, and they may consider you a higher risk. Again, inquiries are about 10% of your score. Let's do a quick recap. 35% is payment history, which mainly consists of negative or positive information. 30% is debt, how much you have and what type. 15% is the length of your credit history. This is how long you've had credit. 10% is credit diversity. This is the different types of credit and experience you've had. 10% is inquiries. This is when a creditor checks your credit report. Keep in mind there are many different types of credit scores. Each one uses its own scoring model. We've touched on this subject a couple times throughout the course of this first lesson, but I wanted to go ahead and dig just a little bit deeper because it's so critical to credit. Debt is the single most critical factor on your credit. I'm going to repeat this again because if there's anything I really want to stick in your mind, it's that every dollar of debt you owe is considered a risk factor. The more debt you owe, the more likely it is that you will not repay it. Statistically, every dollar of debt will hurt your credit. Another tidbit that you should remember is that different types of debt have different impacts on your score. Revolving account balances hurt much more than any other type of debt. This is primarily due to the fact that the accounts once paid off can be reused again. Again, credit is a numbers game and everything is a mathematical and statistical conclusion. Credit scoring models use these complex mathematical algorithms to determine the likelihood of repayment, which in turn determines the risk assessment. Ideally, keep your balances at zero on your revolving accounts. Installment and secured accounts hurt less. These may include homes, vehicles, or personal loans. As long as they're not revolving, like credit cards, they will have a lesser impact on your credit and your credit score. Alright, so here are a few tips to optimize and increase your credit scores. Of course, you only want positive and accurate information on your reports. If you do not, your credit's going to suffer. If you have mistakes and accuracies or outdated information on your credit report, there is a way to fix a lot of that. If you have negative information on your report, obviously you should begin repairing it, but there are also ways to minimize those items even if you are not successful in removing them. First, make sure you have a good mix of accounts. You should have at least 1 installment loan and 3 revolving credit cards. But make sure you keep your revolving balances low. Pay down your revolving accounts, such as credit cards first. Try to keep them either very low or 0 balances. Remember, you have to play to score. If you do not use revolving credit cards every couple of months, they may stop reporting. Credit card companies pay to report your account information to the credit agencies. Accounts that are idle or show no activity will stop being reported. I always recommend that you buy a small ticket item with each card every 90 days or so to keep them reporting. So you can use your accounts, but just keep your balances as low as possible. If you've been paying on time, most creditors are happy to increase your credit lines. That's right. Some of them do it automatically, some don't. Try calling your credit card company every 6 months or so and tell them that you'd like a credit line increase. Okay, so your oldest accounts are your most valuable when it comes to credit, so it's important that you keep them open. Even if there is a yearly or a monthly fee, consider keeping them open, because closing an old credit card can damage your score. Another important tip is opening and maintaining new accounts that report to the credit bureaus, and it's a key to building a solid credit rating. There are many different types of accounts that you can be approved for, even with a poor credit rating. Typically, you'll pay a higher interest rate, higher fees, or you may have to secure the account with collateral, such as money or assets, in order to open accounts if your credit is less than perfect. Credit history accounts for about 35% of your credit score. Therefore, if you don't have sufficient credit history, you need to open new accounts and pay the price if you ever want to increase your scores. We've covered a little bit about inquiries earlier and how they impact your credit. Each and every time you apply for credit, an inquiry will appear and it can drag your credit scores down a few points. So try not to apply for credit unless you're either trying to build credit or you absolutely need something. Lastly, make sure your personal information is accurate and up to date. This includes your name, Address, previous addresses, social, date of birth, and employment history. When lenders or potential employers pull your credit, they may check to make sure the information that you placed on your application matches what the credit bureaus have on file. If not, they may consider you a higher risk or turn you down for the application or the job that you applied for. There is a technique that does work, and not many people know about it, and many of those that do really don't understand it enough to make it actually work. I'm going to explain this in detail for you. So, one of the fastest and easiest ways to add instant credit history to your credit report is by piggybacking. There's two different ways you can piggyback. One as an authorized user or two as a joint account holder. Now each has its advantages and disadvantages, and I'll explain exactly what those are. What is piggybacking and which method should I choose? Well, piggybacking is a technique that allows you to inherit someone else's credit history by being added to the account, typically a credit card. Piggybacking can season your credit and increase your credit scores faster than almost any other method. When the general public caught on to this trick a few years ago, it spawned an entire industry to meet consumer demand. There are companies that you can pay to piggyback on a complete stranger's credit card account. They call these companies trade line dealers. They pay cardholders to rent out spots on their credit cards, but only as authorized users. Some credit card companies allow 20 or more authorized users, so the trade line dealers charge anywhere from a few $100 to a few $1,000s to rent out these spots. The authorized user never gets the actual credit card, but the account will typically show up on their credit report. Now eventually the banks, lenders, and credit scoring providers caught on, and the scoring models shifted the weight of authorized users to minimize this practice. With that being said, authorized users on most cards do not carry much weight, and they have a much lesser impact unless the primary on the account is a family member or a spouse of the authorized user. So this is how it works. First, find someone that you really trust, someone that you trust with your life. Because this person, they must have a credit card account with a major bank and in good standing with low or preferably no balance. Also, you want to choose an aged account, one that has a really long history, the older the better. And finally, the primary must be willing to add you to the account. I say in good standing because you don't want to inherit a negative account, right? I said preferably low or no balance, because if the account has a high balance or it's maxed out, it's only going to hurt your scores. It's going to increase your utilization. Lastly, I mentioned that you want an aged account. Why is that? Well, the older the account is, the longer the payment history is, and the more it'll help your credit. Okay, so now that you've chosen the right person to help you out with the right credit card, now your friend or family member calls the credit card company and requests to add you as an off-authorized user or a joint account holder. You need to pick one. The credit card companies are usually more than happy to add someone else to the account. So you should choose authorized user or joint account holder. Which one should you choose? Well, that really depends on a few things. Just try to remember this. One, credit scoring models will not place much weight on an authorized user account unless the primary is your spouse or family member. Secondly, as an authorized user, you have zero liability. If the account ever falls behind, has late payments, or the primary maxes out that credit card, you can have it removed from your credit. Just as easy as it was to add it. Just call the creditor and ask them, and they'll remove it from your credit report. Now, on the other hand, if you choose to be a joint account holder, you are permanently responsible for the card forever. Okay, it's really important that you make sure that the primary account holder is a responsible person and intends on paying on time and keeping the balance low. Otherwise, there's a really good possibility that you're going to end up with problems. As a joint account holder, if the primary maxes out the account, is late, goes to collections, gets a judgment, or files bankruptcy, you are equally responsible for it, just as if you co-sign. Unlike an authorized user, you cannot simply ask to be removed, it's permanent. So just be very careful. Next, be sure that you monitor your credit reports to make sure it gets reported to the bureaus. Provided you did everything correctly, this account should show up on your credit report within the next 30 or 60 days or so. The next time a lender pulls your credit, it will recalculate all 3 credit scores and include the account, just as if it was yours. The entire payment history will appear on your credit report and will be calculated into your new scores. I've personally seen this technique work wonders to boost scores, but I've also seen it cause catastrophic problems, not only with credit scores, but relationships with friends and family. My best advice to you would be to make sure you take your time, your due diligence, and be careful who you share accounts with. So, there you have it. We've reached the end of lesson 1. That wasn't so hard, was it? What I'd like you to do now is read all of the text in the PDF in the description below, and I'll see you in the next lesson. Remember, if you need more guidance or if you just want the experts at zoomazip.com to do all the work for you, just email expert@zoomazip.com. If you have any questions, drop them in the comments below. Thanks for watching. Don't forget to like, subscribe, and hit that bell icon for more tips on managing your credit and personal data. Visit zoomazip.com for more info and take the first step towards a better credit future. See you next time.